You know, when we talk about global finance, we usually picture a crazy, bustling stock exchange floor in New York or Tokyo, right? Well, there is actually a market out there that completely dwarfs all of those combined. It operates silently, seamlessly, every single second of the day. Today, we're decoding the foreign exchange market, or as we all know it, Forex. We're going to dive right into exactly who provides the liquidity, how the different players engage, and the invisible architecture that keeps the world's currencies flowing.
$6 trillion. Let that sink in for a second. That's not an annual figure, and it's definitely not a monthly figure. That is the daily volume of the Forex market. Every single day, over $6 trillion changes hands. This unbelievable volume is literally what makes Forex the most liquid financial market on Earth. Because there's just so much capital constantly moving, participants can pretty much always buy or sell whatever currency they want exactly when they want to. But you might be wondering, how does a market this massive actually function without just collapsing under its own weight?
While to handle that immense volume without bottlenecking, the market relies on these incredibly decentralized, interconnected networks to keep global liquidity flowing super smoothly. Unlike the stock market, which rings a bell to open and close, the Forex arena operates 24/7 across global time zones. As one region's workday ends, another's is just beginning, basically passing the baton of trading without a single interruption. And remarkably, it operates with a completely decentralized structure. There's literally no single central exchange building. Instead, the whole shebang relies on over-the-counter, or OTC, platforms and electronic communication networks, which we call ECNs. These networks connect banks, brokers, and institutions directly, allowing for seamless currency exchanges no matter the time or where you happen to be in the world.
All right, let's move on to Section 1, the whales, central and commercial banks.
So the crucial point here is that heavyweights like the Federal Reserve in the US and the European Central Bank directly influence currency values through three massive economic levers. First up, they manage national monetary policy, steering the broader economic trajectory of their regions. Second, they set interest rates. And you know, when a central bank adjusts its interest rate, it immediately impacts the yield and attractiveness of that nation's currency to global investors. And third, they intervene to stabilize economies. Through mechanisms like quantitative easing, they can flood the market with liquidity or systematically pull it back. Their motives aren't driven by short-term trading profits at all. They're managing macroeconomic stability, which, as you can imagine, sends profound ripples across the entire Forex ecosystem.
Now for Section 2, the clash, institutional versus individual traders.
This is a super fun comparison where we see giant financial entities meet everyday traders like you. On one side of the battlefield, we have institutional traders. Think large-scale investment banks, massive hedge funds, and multinational corporations. They possess immense resources, trade in substantial volumes, and honestly, because of their sheer size, their trades can actively move the markets. They're generally positioning for long-term investments and large-scale macroeconomic shifts. On the flip side, we have individual or retail traders. This group operates with smaller capital reserves and relies on online brokers to execute their trades. Since they lack the massive scale of the institutions, retail traders frequently utilize leverage to amplify their potential returns. They tend to be highly agile, often engaging in short-term trading to catch quick market momentum.
So what actually drives the lightning-fast decisions of these diverse groups? Well, whether they're acting for a huge institution or trading an individual account, participants are constantly analyzing the board. They're looking closely at economic data, like employment reports or inflation metrics. They monitor geopolitical events, knowing that sudden political instability can instantly devalue a currency. They gauge overall market sentiment to figure out if the prevailing trend is risk-on or risk-off. And to synthesize all this data, they rely on a combination of technical analysis, studying price action charts and historical patterns, and fundamental analysis, which evaluates the underlying economic health of a given country. It's a complex, multivariable equation that literally updates every single minute.
Okay, let's look at Section 3, the facilitators, dealers, and market brokers. Now, how do we actually enter this giant market? Well, the bid-ask spread is the literal cost of entry, allowing dealers to provide constant liquidity. When you execute a trade, you don't just get a single uniform price. You encounter a bid price and an ask price. Foreign exchange dealers facilitate transactions by standing ready to buy or sell currency pairs at any given moment. They generate their revenue from that fractional difference between the buy and sell price, the spread. And this isn't some hidden fee. It's a highly transparent mechanism that ensures there is absolutely always a counterparty available to take the other side of your trade.
And that brings us to market makers, who act as the vital fluid of this entire ecosystem. Imagine a moment of high market panic. Maybe an unexpected geopolitical event happens, and there's a sudden, frantic rush to sell a specific currency. But all the natural buyers have just vanished. Well, market makers step in. Their role is absolutely critical in maintaining market stability. By continuously offering bid-ask spreads, they ensure that the market remains fluid and accessible for everyone, absorbing the shock even when conditions become highly volatile and other participants hesitate to engage.
For individual traders, choosing a broker is step one, and the options vary wildly based on your trading style. Let's look at a quick comparison. For instance, IC Markets boasts a 4.7 out of 5 rating, featuring low spreads, true ECN pricing, and deep liquidity, making it a huge favorite for algorithmic traders and scalpers using platforms like MT4 and MT5. Then we have Admiral Market, with a 3.4 rating, well regarded for its advanced charting tools, robust educational resources, and multilingual support, which is really ideal for those looking to refine their market knowledge. And finally, Fusion Market, sitting at a 4.3 rating. They're a competitive, low-cost broker known for zero commissions and tight spreads, ensuring fast and efficient order execution. These platforms act as the vital gateways, providing the exact sophisticated technology you need to interface with a 24/7 global market.
Moving on to Section 4, Survival Tactics, Mastering Risk Management.
As a smaller fish in this giant $6 trillion ocean, long-term profitability relies entirely on specific strategies designed to withstand wild market fluctuations and protect your hard-earned capital. Risk management is strictly non-negotiable. The first foundational rule: setting stop-loss orders. This is a predefined automated trigger that closes a position if the market moves against you by a specified margin, which strictly caps your potential downside. Next is employing precise position sizing, so never allocating a disproportionate percentage of your total capital to a single, unpredictable trade. And finally, diversifying portfolios ensures that one adverse currency swing doesn't completely compromise an entire account. These are the strict, everyday disciplines that distinguish those who survive and thrive in Forex from those who are just quickly washed out by the volatility.
So, we've decoded the sheer scale of the arena, how central banks set the overarching currents, how colossal institutions battle for macroeconomic positioning, and exactly how retail traders utilize agility, leverage, and the right brokers to navigate the momentum. The Forex market is incredibly vast, strictly decentralized, and perpetually active. As you look at this dynamic $6 trillion engine of global finance, in this huge, decentralized ecosystem, which participant will you be?